This close, guys. This friggin' close to making a video on Afterpay with their crazy surge that they've just had yesterday. Okay, but I've already done way too much research for Flight Centre, and that's the one that's been requested the most in my previous video, in the Webjet video. You can check it out there. And so we're gonna do that today. But congratulations to all of you who went in at such a low price and have profited massively in the Afterpay stock, which is now from its bottom lows gone all the way up to, well, today it's at 26, but yesterday at $28. Man, yeah, you definitely live with some FOMO moments when you're watching the stock market move this crazily. Now, in regards to the markets, there's this one thing that I cannot wrap my head around, and it's one thing that I don't understand, is the sheer optimism there is in the stock market at the moment. Whilst all the bad news is going on, it continues to climb and climb and climb. Now, you could argue that the damage has already been priced in, which is how we've seen such a steep dive in such a short amount of time. But it doesn't justify the big jump back, because these companies aren't going to make any earnings within the next quarter, which is going to be reflected within their reports that are coming up, because people are literally staying at home and not going out to spend anything, and non-essential businesses are closing their doors and going online, which also reduces foot traffic. Now, what I think is happening is that we have people who've still got their jobs, some equities in their properties, and or some cash on the side, and are now deploying it because repaying their mortgage and putting it into a high yield savings account isn't going to get them anything. But at this scale, you can assume that some institutional players are coming in and playing part of their role. Now, I'm not sure, because I'm keeping some money on the side, and if it keeps going up, well, I'll be all right sitting on the side with some cash. And given all the issues at the moment, it seems like all the countries are just trying to print all their problems away. So anywho, due to popular demand, we're going to cover today the other big travel agency in Australia and New Zealand, which is showing potentially another buying opportunity. That is, of course, in Flight Centre. Now, in my previous video, I mentioned that Webjet is Australia's biggest OTA, that's online travel agency. Well, Flight Centre is Australia's biggest travel agency, period. Now, you most likely have seen their storefront somewhere in your local shopping centres if you live in Australia or New Zealand. So basically, we've got another travel company who's been smashed in the stock market. So grab your snacks, grab your drinks, have a seat, because we're going to go through another big analysis in Flight Centre. Now, guys, before I continue with this video, remember to give this video a like, because it does help me out a lot. And welcome to all my new subscribers that have come on board. Great to have you guys on board. So let's get going. So we've got a business here that's an international travel agency, not just Australian bound, which I thought it was at first. But nonetheless, they have agencies all around the world, which are all called Flight Centre, except for in the US, which is called Liberty Travel, which kind of makes sense because, it fits in with the whole American liberty, freedom, all that type of stuff, able to fly because you've got freedom, da 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 da. So how did Flight Centre fare prior to the coronavirus coming in? Well, they were actually doing pretty good with a TTV, that's total transaction value, of just under $23.7 billion, which is an 8% increase from the following year, or almost an extra $2 billion from the previous year, which is generally good because that shows there's a boost in sales. However, when we look at their revenue, which is the money they actually make from the transactions, it's actually gone down from 13.4% to 12.9%, with a juicy $343 million in profits before tax, all of which is achieved with a reduction in sales staff. Now, that's pretty impressive because generally you need more sales staff to make more sales. And if you're able to reduce that as an overhead and continue to have great sales, then well. Now, this was a good result for Flight Centre. However, Graham Turner, their managing director, said that although this was disappointing to be below last year's profit, it was a good result considering the uncertainty regarding Brexit and the lack of confidence in the consumer market growth due to the trade wars and other tensions in the UK and Hong Kong. Now, although I think there was some lack in confidence previously in the market, I see it as a changing market as a whole, because now we've got consumers who want to fly at a cheaper rate. And when you've been targeted with Facebook ads about flights for $500 return to and from Japan, I'd rather much be clicking on that, going straight to the site, going straight to Jetstar and booking, as opposed to going through a middleman who might force me to pay just a little bit more, or 2 to 3 times the amount for a different airline. Now, I made mention of this in the Webjet video, but basically because the margins are constantly being squeezed due to the cheaper flights and consumer expectations heading towards that way, it's no wonder why we have Webjet making more money through WebBeds and doubling down on that. And here we have issues with the Australian leisure market going down and growth coming from the corporate sector and internationally. Now, if there's one thing that our domestic companies always tend to do when they're trying to grow quite drastically, is that they'll always head international, because they need to be going to the markets where the biggest growth potential is always going to be at. Bigger growth potential, bigger market means much more transaction and more bigger dollar billios. Now, we've seen this with Afterpay when they moved over to the US, which saw the stock in the ASX skyrocket to all new time highs. And Flight Centre's largest growth market is in the United States, and in particular the corporate sector, which has grown by 30% alone in that country. And with the weakening Australian leisure market, it's no wonder that 52% of their TTV comes from the international markets as a whole, which helps soften their result that they've been receiving in Australia in the past couple of years. Now, if we compare Webjet to Flight Centre, they're not even in the same league. Like, if we have a look, we have $23 billion in TTV versus $3 billion in TTV, and their net profit after tax is $264 million versus $81 million in Webjet. And the earnings per share is much greater with Flight Centre than it is with Webjet also, which is another thing to consider when we're talking about capital raising and the dilution of that EPS. So on a numbers basis, which I just showed you, it would suggest that Flight Centre is 3 times the monster that Webjet is with its net profit after tax. But let's look at their respective growth and business models. So if we have a look at the growth of Webjet from 2018 to 2019, all of their earnings have been going up by double digits in a year. And we're not talking about 10%. It's been 20, 30, 40+% in a year. Whilst Flight Centre is down in some instances and just up a little bit, if up at all. So as a growth engine, Webjet destroys Flight Centre, and it's not even a close. Close the flight with the left, right, good night in terms of growth for Flight Centre. Another thing to consider is that Webjet is an OTA. So its overhead over time should not be as big as Flight Centre's, who continues to have sales staff and office space. For example, for Flight Centre, they have 2,800 stores, and Webjet being an OTA is, well, only online. The traditional brick and mortar will and already has with the Ronie / many stores, which reduce overhead but loses them foot traffic and brand retention when people are visiting their local stores in the future. Meanwhile, Webjet will continue to operate as an OTA, which, well, people have known it to be in the first place. In saying that though, there's really no clear indicator from this who's going to be better. It really comes down to what you're looking for. Either a strong and steady brand in Flight Centre because people will go back to it and want to travel again, or a more mobile Webjet whose business operates online. What they do both share in common is having to deal with the softening Australian market. So whoever you're betting on, they better be damn sure to have a very strong international presence and business model. Another issue I have with Flight Centre is last year they paid out $310 million in dividend money, which is silly now knowing what we know, but even at the time they had reduced their cash position to take on more debt, 5 times more debt in comparison to the previous financial year, and gave a special dividend out in that year. Like, how was this even meant to be sustainable? Is everybody just receiving like imaginary dividends right now? Like, we're just raising debt to give out some free money? And you'll see this later on when we talk about the capital raising, why this money, had it been kept even marginally, would have saved the shareholders from having their shares diluted massively. So guys, so far, if you're enjoying the content, make sure you hit the subscribe button and make sure you leave a like on this video. So now we're in 2020 and talking about the Ronie and Flight Centre's first half performance in the financial year of 2020. Now, what has surprised me is that they've actually made an increase in TTV in comparison to 2019. But the issue is here we see a reduction in both profit before and after tax in comparison to the prior year. And also, the dividend has been cut by 33.3%. That's a hell of a lot of threes, and I'm all for it. Cut the dividend. This is an odd situation to be in with more transactions going through but lower profits. But this is a result of having greater depreciations, greater benefits for employees, and marketing, which is totaled to be at $72 million. There were also falls in the leisure sector, which seems to be a continuing trend, and it was hit hard in Australia and New Zealand due to the poor trading cycles, and in the US, where there were safety concerns in the Dominican Republic. Now, although it still foresaw a lesser hit to the business in Feb, I think we can all agree at this point that it's going to be much worse than they had predicted in February. I mean, $300 million is a bit of a stretch when nobody is traveling and when we're issuing rescue flights to get people back into Australia. So yeah, you can see why we're gonna need you guessed it, capital raising. Now, with the announcement of the successful capital raising, the stocks went up, but let's have a look at the trend for this business over time in terms of the stock market. It's actually been trending down for quite a minute, like a long minute. And this is basically due to the softening Australian leisure market, which made up a large proportion of their earnings in previous years. So in regards to the capital raising, Flight Centre was able to raise $562 million at $7.20 per new share, which gives the company a total of $2.3 billion in liquidity, which should see it through the tough time. Now, this and the good news about the slowing cases in Australia, #flatten the curve, saw its shares fly up by 13%. But touching on the prior dividend payouts, you can now see why, if it had kept $310 million instead of paying it out, it would have helped the company. But anywho, shareholders in Australia expect these dividends to come, so I can't really blame the company for that. With this pandemic, Flight Centre has also closed down 30% of its national stores in Australia and stood down about 6,000 employees. And I don't blame them. Remember, this is a brick and mortar business with large overhead. And when their operations for the month is only at 20 to 30% of what it should be from previous years, it needs to make drastic adaptations. With the weakening leisure division, which is only going to be weaker because there's no confidence in traveling abroad to catch some other form of disease, Flight Centre is looking to close down 35% of their leisure stores globally. So with all that being said, my overall thought for this is that the company seems like it's going to see this out and take learnings from SARS. But with the capital raising and all the debt that both Webjet and Flight Centre has taken on, I'm really not interested at all in investing in either of these businesses. And nor was I prior to the drop in the market. But like I mentioned in the Webjet video, this could be a great opportunity if you're looking to make a swing trade, because I think once things quieten down and we see cases start to decline, or maybe a vaccine starts to come through, the shares will go up just naturally. As soon as there's any sense of good business starting to take place again, shares will go up because shareholders will become more optimistic about the business. But that's all from me, guys. I hope you guys enjoyed the analysis. These lights are making me really hot and sweaty. I'll catch you guys later. Cheers.